Good afternoon, everyone, and welcome to this webinar on last week's federal budget for the upcoming 23-24 financial year. My name is Peter Licandro, the Managing Partner of Financially Sorted. I hope that you're all doing safe and well, and certainly getting ready for the winter months ahead down here in Melbourne. We as a team at Financially Sorted thought it'd be a great idea to talk and communicate with our clients on the announcements from this latest budget, what it may mean to you all, both personally, for your businesses, superannuation, along with some personal stuff as well. The team here at Financially Sorted, we're always here ready to assist you. We'll continue to forward newsletters, emails, texts, conversations we're having, social media. So the most important thing, if you need help, feel free to reach out, whether it's today or tomorrow or in the future. We're certainly here to look after you all. All right, let's get stuck into it. So a little bit about the business. So obviously we've got our two locations that we look after, many of you, either at Moonee Ponds or Wheelers Hill. We can obviously help you with our taxation and accountancy services. We also have financial planning and wealth division that can assist. We can look after your self-managed super funds, insurances. We have a loan broking division if you need assistance, along with the businesses that need help with Xero or cloud accounting, bookkeeping, all those type of things. So the idea or the objective which we commonly talk to our clients is build a network of experts around yourself, which obviously would include an accountant, but that could be real estate and property. It could be a conveyancer or a solicitor. It could even be a mortgage broker. So certainly reach out. We'll continue to run webinars like this, keep you updated as best we can. Okay, before we get stuck into the budget, I must, my insurance warrants this, that this is general advice only. It's not taking into account your particular situation or circumstances. Like I said, we're here to help. But many of the stuff that I'm about to talk to you about is general advice only. Obviously, we can't cover everything in a 60-minute webinar, so that's where we're more than happy to talk with you about your goals or your objectives or your situation to assist accordingly. All right, let's get stuck into it. So it's fantastic to have many of you along. I appreciate you taking the time out. And hopefully I'll go a long way towards answering some of your questions or some of the issues that did arise. This budget didn't have too much into it. It was all about, you know, what to expect or what we were looking at expecting. But the good news is there wasn't too much into it, or that's not going to affect us greatly. In this webinar, I'll have we will have a look at some of the superannuation changes. We will look at some of the tax changes that you need to be aware of. There were a few social security measures. We'll also have a look at a couple of other little hidden gems in there. Like I said, there's not too much in it, so I'll also let you know what to do next. And if we've got some time, more than happy, I've got some tax planning strategies or general strategies to assist accordingly. A recording of this webinar is happening for you all. And along with a copy or a PDF copy of the slides that I'm presenting, we will post it on our website. Give us about 24 to 48 hours to do that, and we'll certainly let you know via email a link accordingly, but it'll all be located on our website for future purposes. All right. So in his second budget since winning power in May last year, the Treasurer, Jim Chalmers, he basically, the good news is it was the first budget surplus in approximately 15 years. How did that happen? Especially with the grim outcasts or forecasts that were given to us. There was a lot of strong growth in jobs, and also the mining revenue swelled certainly the coffers or the bank balance, that's for sure. Like I said, there wasn't too much in it in terms of taxes and superannuation, but there are a couple of little things we need to look at. There were a lot of cost of living measures to assist with that, energy relief measures, and energy or home energy upgrades as well. After 11 interest rates rises over the past 12 months, obviously they had to rein it in to help fight inflation. So they're supposedly trying to keep or strike a considered methodical balance between spending to keep inflation in check. So that was the main thing about the budget. But more importantly, let's get stuck into and have a look at some different things. So the first bit I want to have a look at is superannuation. So certainly a couple of budgets ago, when the Liberals or Mr. Morrison was still in power, the super changes were quite dramatic. And the good news from last week was superannuation was quite boring. So this is a great thing compared to what we've seen in the past. So boring is good for a change. One area which does affect mainly those that are 60 or older and that are in pension mode. So basically the minimum pension drawdown that many of you are taking advantage of will come to an end on the 30th of June 23. So in about 6 weeks. So originally in response to COVID breaking, basically there was a 50% reduction in the minimum annual payment amounts from superannuation pensions. That was extended for the 21 and the 22, and even for this current 23 financial year that we see ourselves in. Like I said, that will basically cease come 30th of June this year. So basically pensions are going to basically go back to what they once were. So when we have a look at that a bit further, let's have a look at the rates. So for those of you that are generally aged under 65, you can see that the original pension, if I just show you this here, was 4%. During the COVID years, if we call it that, it was 50% reduction. So that was, you were able to withdraw a minimum balance of 2% of your account balance. From the 1st of July this year, that will increase back to 4%. It is important and it is imperative that you make sure that you withdraw your pension. Be very careful if you're wanting to tip money back into super, because there are some restrictions depending upon your age and also your working situation. And as you can see, as you get older, the amount that you're required under SIS law or superannuation legislation will increase over time. So it's imperative that you follow that. And like always, we'll keep you updated, or if you're not sure, feel free to reach out to either myself or Cassie or any of the other team that certainly look at the superannuation side of things. There was some talk around super guarantee updates. Basically, the good news, or depends which side of the fence you sit on, is that there were no changes to the previous legislated super guarantee rises. So here we are in the red bit, basically that at the moment, those of you that are working ordinary time earnings, that your employer will be paying 10.5% on top of your wages to your nominated superannuation fund. That is due to increase, and there was some speculation around, but no changes. So come July 1, that will increase to 11%. The following year, 11.5%, and the following year after that, it'll be up to 12%. There was talk pre-election, so 12 months or so ago, that Labor government could be looking at even increasing this further. So there's sort of two sides of the seesaw here, that if you're an employee, fantastic, your boss should be tipping more into super. Please double check that it's actually happening. You know, there's a lot of businesses out there at the moment that we're finding with cash flow problems, and something like superannuation could be something that they would delay. For those of you that do employ or have employees that are working for you, bear in mind, this is going to be extra costs on top of probably cash flow concerns that some of you are already having. If you're using, for example, cloud technology to help with your wages, perhaps Xero software, which we know many of our clients are using, that should automatically tick over come July 1 to calculate the right amount. Also be careful though, by increasing super, your there'll be extra work cover that you'll be subject to, because the premiums, when you declare the wages levels, will go up. There will also be, for those of you that are paying wages in excess of about 700,000, there will be increases in your payroll tax liabilities as well. So it always has an ongoing effect. So I just thought I'd cover that. Although there was no changes in last week's budget, it's certainly important to know whether you're an employee or a business owner, where you stand in that regard. And the other thing is, make sure your super is actually working. It doesn't matter whether you're 25 or 55. It's never too late, but it's always good to check that it's performing how it should. Now, in relation though to super guarantee, there are some changes coming. They're not due to commence until the 1st of July 26, but basically employers from that date onwards will be required to pay their employees super guarantee entitlements at the same time as they pay their salary and wages. So basically, as it stands at the moment, employers are currently have to make super guarantee charges. However, it's done on a quarterly basis. Some employers do it sooner rather than later, for example, on a monthly basis, but the law is on the quarter. So April, May, and June is required to be paid by law by the 28th of July. And it goes on like that each quarter. If you do not do that, then there's extra administration and possible fines and penalties involved as an employer. Now, just to make a bit more work for the bosses out there, from July 2026, like I said, employers will have to make this super payment on the same day as you pay your employees. So if you pay your employees every Friday, let's call it, at the end of the week, at the same time, you will lodge the STP paperwork, or not paperwork, through the cloud technology such as Xero. As a boss, you will have to pay the superannuation as well. That could affect cash flow, but basically that's where the government is heading. Now, they haven't told us how, what, etc. They've basically introduced it, and now they've put the onus back to software companies, to the ATO, to come up with a way that it will happen. Now, according to the government, this measure benefits the lower paid employees or casual and even insecure workers, because basically they believe by forcing the employers out there to pay it more frequently will deter or stop it perhaps not being paid. But like I said, as it will cause cash flow issues, I'm sure, for companies, and there will certainly be some more administration requirements. So they're the problems that the business sector is screaming. All I can do in this case is say, stay tuned, that we'll see what happens and how it's going to work, and we'll certainly keep you updated accordingly. There was also some superannuation changes or further changes, and this stuff was announced back in March, but it was reinforced in the budget obviously last week. It doesn't affect too many people, and they've obviously introduced some more taxes at the higher end of town. So anyone that has a superannuation balance of more than $3 million. So basically that's where it'll get effect from, and this will commence from July 2025. So it's still a couple of years away. So basically, earnings that exceed balances or earnings on balances where there is more than $3 million in your super fund, they will get taxed at 30%, up from the current rate of 15%. So there is no restriction on the size of a super fund or what your balance can be. It's just basically in a pro rata basis, that if your super fund, for example, has $6 million in it as your balance, then what will happen is, and let's say it earns 200,000, then 100,000 will get taxed at 15%, and the other 100,000 will get taxed at 30%. So like I said, it is a few years away. There is some, again, backlash in this regard, because sometimes, and as an example, someone could purchase a property, let's say 5 or 10 years ago for $1 million, and all of a sudden it rises over the years to be greater than $3 million. There is nothing in the legislation that talks about CPI or bracket creep, or that it should be adjusted over time. The government has basically come out and then said stiff bickies in that case. So what does this mean for a planning purpose? If any of you are getting close to that number, is it worth withdrawing cash or selling down some of the assets? We have to be careful of your age and whether you're in pension mode and different things like that. And like I said, the main areas that this will affect will be probably property and even shares and managed funds, that as they grow over time, it could tip you over that $3 million. However, many would say, and I think the number that the government came out with, that this will affect like about 81,000 people, supposedly, according to their data. I can see it being a problem in the future, though, like I said, where many super funds invest in property and those properties continue to grow at the rates that they're currently growing at. But the bottom line, let's have a look at it if you're getting close, and we've certainly got the team that can help put some things in place ready for a couple of years away. There was also a hell of a lot of noise out there, pre-budget or speculation, around stage 3 tax cuts. So they were again introduced and promised a few years back by Mr. Morrison at the time. Mr. Albanese went to last year's election saying there will definitely be no changes. However, there was a lot of speculation that would change, but the good news is that nothing was mentioned in last week's budget. So with the tax cuts, as it stands, they're due to come in on the 1st of July 2024. So still another 12 or so months away. But basically, as it stands now, you can see how the current tax regime works. You know, anyone that earns up to basically 18,000 is taxed at nil, and then as you progressively earn more, you get taxed. From next year onwards, they're basically wiping out these middle tax brackets. And as you can see, it won't change really for anyone that earns up to 45,000. But then in the future, anyone that earns between 45 up to 200, rather than having this sliding scale system, you can see it's just going to be a flat rate of 30%, basically. And then anyone that's earning greater than 200 is again a flat rate. So they're basically removing this middle class, or the middle income earners, as they call it. Stay tuned. We do have another budget, obviously May next year. There is still speculation around there will be changes to some or all of these tax cuts. Basically, it's just a let's see what happens situation in that regard. But certainly, if anything in that regard changes, we will be the first to let you all know. Medicare levy, that's one of those fun things that we all pay. As it stands at the moment, you can see the current levels of before Medicare levy kicks in. So Medicare levy is anyone, depending upon, for example, if you're single and you earn more than 23,365, you are basically, your taxable income will be multiplied at 1.5%, which will be the amount of Medicare levy that you will pay to supposedly fund our hospital system. For this current year, you can see the increase of some, what's that, approximately $900. And depending upon the different or the category you fall into, there'll be a little bit of relief there. Also, be very, very careful for those that earn a bit more. If you do not have private health insurance, you could be subject to what they call Medicare levy surcharge. And in some cases that we see with clients, the Medicare levy surcharge, or I call it a bit of a penalty, can actually end up being higher than what it would cost you to have private health insurance. So be very careful, and certainly ask us questions if you're not sure where you stand in that regard, because we all know the hospital system's in a bit of a mess, and it's hard enough to get in at the best of times. So it's important that you have options, whether it's public or private, available to you. These thresholds usually increase a little bit each year, so I expect them to increase slightly again next year. Pay-as-you-go installments. All those, many of you out there that are running businesses, or individuals that have some extra income or investments on top of their salary and wages. It's one of those things, pay as you go, where you basically get a bill every quarter that you must pay. Currently, what happens is every single year, we lodge your tax return, or when we lodge your tax return, your latest data is provided to the ATO, and they presume that that data will carry on for next year. Then they basically say, we expect, and as you can see, quite a big increase, we expect a 12% increase. And that might be, for example, if you have a rental property or dividends or a bank interest. So what they say is, yep, we will factor in a 12% increase for pay-as-you-go purposes. The good news is from the 1st of July 2023, so only 6 weeks away, that 12% increase is now dropping to half, or a 6% increase. So basically that's a good thing, which means your pay-as-you-go instalments should not rise too dramatically. Okay, now I just do want to mention a couple of things, and then we'll talk about how this affects GST as well. Be very, very careful. I know we as a team have spoken to many of you over the last 12 months, but in about July last year, the ATO quite dropped a little bombshell where if you vary your pay-as-you-go instalments, which you have every right to do, and they end up being out, so in other words, they're out by more than 15% come year end, when you reconcile and complete your tax return, the government has the ability to fine you. So what's happened in the past, and especially during COVID, because of people's cash flow concerns, is someone might have to pay tax at the end of the year. And let's just call it $10,000. So that would mean every quarter you have a pay-as-you-go instalment of $2,500. But clients in the past have said, you know what, just get rid of that. Let's vary it to zero, and we'll just cop the bill at the end of the year. The ATO have basically come out and said, no problems in varying it, but if you vary it down by too much, we're going to get that money and we're going to charge you interest and penalties on top of it. Now, this has been law for a long time, and we haven't seen them as accountants do it. However, we have as accountants seen the ATO certainly increase questions, chase debts. They went to sleep during COVID for about 1 to 2 years. They are back, and they are back with a vengeance. And I will show you later on in this presentation about a little thing that was hidden in the budget, where the government's allocated money for them to run even more reviews and ask more questions. So you need to be very careful with variations, guys. That's the message here. Now, just as we mentioned GST earlier, so this change in pay-as-you-go instalments, it will also apply to GST instalments. So some of you out there, rather than calculate the GST on a quarterly basis, elect to basically just pay an instalment and then lodge an annual reconciliation at the end. Again, if we vary that annual reconciliation rather than following the ATO predetermined rate, then we could run the risk of penalties in that regard. Now, I also just remembered, I forgot to mention at the beginning, if any of you have any questions out there, whether it's on anything I'm talking about or anything else, feel free to use the chat box, and we'll certainly, I'll do my best to answer them as we go or at the end. And if we run out of time, I'll certainly have a look at them all at the end. We will record them, and we'll put them in our responses with an email. So no problems at all. Happy to help where we can. So the message here with pay-as-you-go and GST, if varying, be careful, and they should not go up as much as what they've done in the past, which is a good news. Another thing that's going to affect businesses out there is the instant asset write-off rule. So again, this was something that was introduced for small businesses. What is a small business? It's anyone with a turnover of less than $10 million, where when COVID hit, the government encouraged or wanted businesses to spend money. So they introduced this measure, which will cease on June 30 this year, where businesses could accelerate depreciation or claim things or write things off quicker than what they previously could. So anyone that was or is currently spending up to $150,000, for example, on a vehicle, plant and equipment, it's a per asset base, then that would be straight to your P&L and would reduce the taxes accordingly. Okay. The key is the asset must be installed and ready for use. So the common example of that is I have clients ring and say, I'm looking at spending $100,000 on a couple of utes for my business. Can I claim them? And the answer to that is yes, when they're available, when they are in your driveway ready for use, not just because you've paid $1,000 deposit and it's 12 months ago because it's stuck on a boat out in the middle of the Pacific Ocean. Now, the rule that's changing is from July 1, they've allowed it for another 12 months. However, the $150,000 rule will be reduced to $20,000 only. So that's going to wipe out many motor vehicles, some of the big machinery, for example, that businesses have taken advantage of over the last few years. So as a little bit of a tax tip, if there's any businesses out there that are looking at buying equipment, and it might be in August or September or early next year, if it's more than $20,000, can you bring it forward to this year? Because at least this year you get an immediate write-off. Next year you will not, unless the asset is less than $20,000. If the asset's more than 20, or what'll happen 12 months later, is it'll be placed in the normal depreciation pool, and we will claim it under the existing rules. So you need to be very careful, and there's just a little bit of a tip there. The government have basically, or Mr. Chalmers came out and said, enough is enough. We can't afford this measure anymore. So that's something that will change from July onwards. Like I said, if you're a little bit confused with that rule or want to understand how to take advantage of it, reach out to our team pretty quick, because come July 1, that door is now shut or slightly shut because of the reduction. All right, so that was pretty much it with businesses and even superannuation. Let's have a look at a bit of the Social Security updates or changes. So to help with the cost of living pressures, basically there's an extra $40 per fortnight from the 20th of September this year, so it's still a couple of months away. Where those of you, or you may have family that are on job seeker, youth allowance, parenting payments, Oz study, and there were a couple of others in there as well, that your fortnightly payments will increase by $40 per fortnight. Many of the people out there argue that this didn't go far enough. However, Mr. Chalmers basically said that that's all the government could afford without putting pressure on inflation and interest rates. I suppose we'll only interest rate as the Reserve Bank meet on the first Tuesday of every month. So we're still a couple of weeks away where we'll know if that's true or false, and we'll see what happens with the interest rates in the future. What they also did with Job Seeker is they changed the qualification rules. So currently, JobKeeper, you have to be 60 or older to qualify. Basically, they are dropping that age to 55. So that's probably a good thing, because people argue that as they get older, it's a lot harder to find a job out there. So Job Seeker kicks in and covers them accordingly. However, it does mean more pressure on the budget because the government, or really us as taxpayers, are paying for that. So ultimately, they're trying to help those that are out of work. And it does apply to those, in this case, that have received JobKeeper already for greater than 9 months or 9 continuous months. But that's a thing that will change in September as well. There were some updates to the parenting payment for singles out there. So this is generally where children or where you have a single mother or father raising children. Basically, as it stands at the moment, is parenting payment for singles cuts out at 8 years of age when the child gets to 8. This will be almost double to the child getting to 14. And there was talk that they're looking at increasing that to 16 in a couple of years. So basically their argument there was improved support for single parents, where they'll provide benefits, single mothers especially, where they'll cover you for a longer period of time. This can help with, getting back into work, or making sure that your the lifestyle or the cash flow is still there for those carers of the children. So again, probably a smart thing to do, except that it, what effect will it have on the budget, or the how much as taxpayers will it cost us in the future, is probably the big thing to consider. All right, so I did mention to you earlier about the ATO and the increased powers that they have. So this is basically where all that comes into play. So tax compliance, or integrity as they refer to it. So back in basically the government has turned around and provided some $325 million, and then another $300 million to the ATO. And they've basically said, called it Tax Avoidance Task Force. And this is basically going through to 2025. So in previous years, the government has allocated these monies to this force. It was established back in 2016, and it was basically to undertake compliance activities targeting multinationals, large public or private groups, and even trusts and high wealth individuals. In other words, are they paying their fair share of tax? It also scrutinises tax advisors like ourselves, and it basically looks at those out there that are promoting perhaps tax avoidance schemes or strategies. So now, in the past, the government basically put in the budget, by spending this money, they expected it to generate $2.1 billion in revenue by spending this money. So many would argue it's a decent return on their money. So that's what happened in the previous year's budget. What happened this year? Well, basically the federal government have extended it for 2 years. And the scope from July this year has been extended further. So it's basically to capture more people. The ATO's focus is on rental properties and holiday homes, basically like Airbnbs. And it basically means that us as accountants, and many of you I know have asked us this, is that we're asking more questions of you, or perhaps saying, do you have the receipts, or can you provide them to us, just to ensure that if the ATO asks questions, we know and we can help you to basically provide the information they require and tell them to go away. And again, the government has basically extended it and spent some, or allocated some $475 million for this. And they expect that it will happen for the next 5 years. And basically, they're looking at doubling or tripling their investment back. So be very, very careful, because the ATO every day have new technology. You know, short-term rentals or Airbnbs is something that they are targeting. They've exploded in popularity over the last few years because many people had holiday houses. They couldn't use them for obvious reasons. So what they did is set up Airbnb situations or investments. And that's okay. You're allowed to do that, and good luck to you if it's generating extra revenue. But just remember, whether it's all the cutlery that you're buying or the sheets for the bed or the little knickknacks that are throughout the house, please ensure you have receipts, because that's the extent that the ATO are going after. So very, very important. This year's budget as well, there was some money allocated for GST compliance. And they've basically said that they've allocated $600 million, which will cover the next 4 years to address emerging GST revenue. 600 million, they're expecting that over the next 5 years, this will generate 3.8 billion in extra revenue to the tax office. Again, they've got a lot of tools out there going on, and they're looking at different things with GST. GST is confusing at the best of times. Guys, please, if you have any questions, like you do in a building development, there could be GST implications. You need to ask questions, even to do with your business. And that's very, very important. So they've basically, the government's covered tax compliance with focusing on Airbnbs and rentals. They've covered GST compliance. And guess what? They've even got some other areas that they're looking at. So this is just more information about the GST side of things. But be very, very careful. Basically, they're looking at providing or targeting businesses that are growing rapidly. They're looking at targeting businesses that are falling behind with either their debts to the ATO or superannuation liabilities. And they're basically looking at ensuring that these businesses either catch up, or in one way, they're going to send them broke. So there'll be a lot of interesting times coming up. Anyone that has a debt with the ATO that's older than 2 years or greater than $100,000, you will jump straight to the head of the queue. And if you haven't already, certainly from the 1st of July this year, you will be targeted. Obviously, with what happened a couple of weeks ago, be very, very careful with the messages that you're getting through your MyGov accounts, because we've found that that's been hacked. So by all means, give us a call. Shoot the girls here in the office an email and just double check. We can always bring up your ATO account to see if there is a debt or if there is a lodgement outstanding for whatever reason. But be very, very careful is the message. So in summary, with the ATO, like anything or any government department, the ATO is watching. And many of you property owners out there would have seen the skyrocketing prices on your land tax bills as well, which is a state government or the state revenue office. They're all talking, they're all watching. So now the ATO, they're chasing amounts. They've been allocated monies to do that. Like I said, the main targets, Airbnb, rental properties, And CGT calculations are big as well, capital gains. So if you dispose of some shares or a property, be sure to tell us, guys, because the ATO have their power to find out. Land tax is a big target as well. Many of you I know have got land tax bills that are out of control. Some of you as well have got bills that go back for 4 years because they missed them in the past. Be careful, they're watching is the key. And please, if you haven't got your compliance work up to date, like your 22 tax return, or maybe older ones, get your information together and get it to us quickly. Because in the past, we've been able to object to penalties. A lot of that, they're not listening anymore. So be very careful. On top of the federal budget, and what do we got? About 15 minutes. Okay. So basically, Victoria. So next Tuesday, the 23rd of May, Mr. Andrews and Tim Pallas as our treasurer will be handing down the state budget. I'm sure you've all tuned into the radio or seen the budget reports, media suggestion, and even Dan Andrews has come out in the state government and has warned that a horror budget looms as Victoria's ability to get on top of its debt and the economic situation is quite scary. What does that mean? I'm a little bit worried about land tax continuing to rise in the future. That represents about 40% of the government revenue on an annual basis. There is speculation of some type of rental tax. I don't know what that means. I've just heard about it. Payroll tax increases. They're looking at cutting some infrastructure projects. And the Melbourne Airport rail link is an example of one of those. Public sector downgrades or sackings supposedly are on the way. And speculation continues. We'll know within a week what happens next week. But as we know, probably the government's in a little bit of a mess and struggling to pay the annual interest bill. So from my perspective as an accountant, they need to make some cuts or they need to raise extra revenue. It'll be probably a combination of both, and time will tell what they hit or what they target. So stay tuned in that regard. Now, I've got a couple of slides here on tax planning. I won't go it through in too much depth, but I just thought I'd cover a couple of things as we're getting closer to the end of the financial year. So the objective with any tax planning out there is to income. It's to legally minimise it where you can, and expenses to legally bring it forward where you can. So basically that's what anyone's objective, doesn't matter whether you're a business or an individuals, that's ultimately what you should be looking at doing to minimise your taxes. Just to have a look at that a little bit further, income, how do we legally minimise things? Can we salary sacrifice? Perhaps into super if you're getting a little bit older. Can we utilise mortgage offset accounts? Can we delay any income legally? Be very careful with that one. Okay. For example, salary sacrificing strategy. In this case, just as a very, very simple example, someone that earns 120 has a tax bill of about $34,000. However, let's say you salary sacrifice $13,000 into super. Your tax bill now becomes 29, down from 34. The super fund, however, will pay about 15% on that $13,000, so about $1,950. When I add these two together, compared to the 34, that represents a tax saving of about $3,100. The catch is though, you've tipped your money into super and you'll have to wait till preservation age, which generally speaking, the earliest is 60, before you can access your money. But ultimately, that's a strategy with salary sacrificing. There's an example here of mortgage offsets, which I won't go through too much, but generally speaking, why pay money to the bank if you don't need to? And basically, you can offset it accordingly. So if anyone's got any questions with mortgage offsets, we're certainly here to help in that regard. And delaying income, can you defer invoicing? Like I said, be very, very careful with this strategy. Expenses, what can we do there? We can accelerate tax deductions. Can we utilise government offsets or rebates, reinvestments back into the business? So again, having a look at a couple of others. Bringing forward expenses. So basically speaking, if you're going to, whether it's a business or perhaps those that, for example, have investments like a rental property, if you've got bills coming up in July or August, even in September, can you bring them forward to June so that way the tax deduction's in this year? For example, prepay your council rates, prepay your insurance premiums. Is there things that you need to buy for your office? Do you need a new mobile telephone? Instead of buying it in July or August, is it worth buying it if it's business related in June? Those of you running businesses, pay your super guarantee for your employees before June 30. Even though you've got till the 28th of July to do so, bring it forward. And you prepay your rent for the next month or two. The catch is that any prepayment, there's a 12-month rule. So you cannot do it more than 12 months in advance. That's the key. So you can't bring forward 5 years worth of council rates bills and pay them, or perhaps bank interest with the bank. So be very careful in that regard. The 150 rule that we spoke about earlier, it's getting removed on June 30 this year, dropping down to 20,000. Is there anything we can do to take advantage of that? Ask if you need help. Superannuation, like I said, all of you out there have the ability, or for tax deductibility, 27,500. Personal contributions can be made. You can make contributions on behalf of your spouse. Again, superannuation is a very complex area. For example, if you're making personal contributions that you would like to claim as a tax deduction, we need to fill in an intent to claim form. Otherwise, and you need to advise your super fund accordingly. For those of you that we help with self-managed funds, we can take care of that paperwork and assist you. For those of you that have, whether it's retail or industry funds, you need to complete and lodge this form to let your super fund know. Okay, so I'm wary of time, so sorry that I'm skipping through these last couple. But just to wrap up over the next couple of minutes, one thing, financial planning and insurances, guys, especially since we've gone through the COVID effect, should be at the top of your list with looking at. So how is your super performing? How are your investments performing? Will they provide your goals and objectives, whether it be today or in retirement? Your insurances, if something drastic was to happen tomorrow or a health situation, then it's important that your loved ones that you might leave behind, or if you can't work, you've got an income protection in place or go through a trauma, that you're covered. Speak to us today. No obligation, just have a chat, ask questions. We're here and we have that ability. Daz is here to help, which I know he does with many others out there. Like I said, check out our website. A copy of this webinar will be added, but we'll certainly let you know once we've done that. But on our website, there's tax checklists, there's PDF brochures on properties and occupation guides. There's over 30 occupation guides. You know, if you're a nurse, for example, it tells you what you can claim or what you can't. So the website's there for you. If there's anything that you need, let us know. We'll have a look at it and see if we can get added to. No problems at all. What to do next? So remembering one thing, the budget updates that I've gone through, they are not law yet. They need to get legislated. So they need to go through both the Parliament, the Senate and the representatives up in Canberra. So please don't make any decisions what I've spoken to you about today. They need to get legislated and we need to make sure that it's within your interest. Have a crack at our website, download anything that you need, talk to us, ask for assistance, whatever we can do to help. So just before I wrap up, I do have a quick question here. Someone has basically said, can I refinance and still claim interest on my rental property? The short answer is yes. Providing that interest and that loan currently relates to your property and you're just doing a refinance, then that's okay. Please though, if you're borrowing more or changing things totally, ask us before you do it. Very, very important. Okay, so just in summary, talk to us for assistance. Those of you out there, like I said, the ATO have the power and have the money that they're getting hungry. If you haven't got your compliance up to date, tax returns, BASs, super payments, state government like payroll tax or land tax obligations, get it up to date. Talk to us today. There's our contact details and many of you have our personal emails and obviously the office phone as well. But in summary, thank you very much for joining us and taking the time out today. Really appreciate it. Thanks for your support over the years. We greatly appreciate that as well. And if there's any questions, whether it be about today or anything else, feel free to reach out. Take care and have a great day, guys. Cheers. Bye-bye.